A lot of people ask me, hey Hima, we pay a lot in taxes because of our high W-2. How can we reduce on taxes? So the number one way to reduce your taxes is fund your 401k, guys. I cannot stress this enough. That is the number one, the most easiest way to reduce your W-2 income is max fully fund your 401ks. And if you have mega backdoor available at your workplace, which is available at most of the tech companies here, at least in Silicon Valley, please do that. Okay. And if that is not something which is available to you, there is another way in which we can reduce our W-2, and here is how that goes. So we have like two kinds of income: passive income and non-passive income. Your passive income is from your rentals, your stocks, and your non-passive income is from your W-2, 1099, or active property management. Right. So for example, let's say you have like some gains in your stocks and you had some losses against your rentals. So as long as they are both on the passive side, you can write off these against each other. Similarly here also in your W-2, let's say you have some positive W-2s and you have some losses over here, they can be used to write off against each other, but you cannot write off across this bucket. Like each bucket we can write it across, but they cannot cross over, right? So for in this active property management, we have something called a rep status, which is real estate professional status. When you have a rep status, you can do something called the accelerated depreciation. Let me talk about that in a bit. So to have the rep status, you need to spend 750 hours a year in that, or which is about 50% of your working hours. So you need to spend 750 hours in a year in a property management. And when you have that rep status, you are eligible for something called accelerated depreciation. So for example, let me talk about what is accelerated depreciation. For a normal residential property, we have a depreciation. A normal residential property depreciates over 27 and a half years. That is the rule set by the IRS. For example, you have a 1 million property, and let's say you have a 3k rent for that. So in a year, the rent for the property is going to be 36k, right? And this 1 million property, you can depreciate it over 27.5 years. So that would be about 3,000 something, like 36,000. So you can write off these, you can write off your depreciation against the active income which the property produces. So let's say when we have a residential property, which I just talked about, in the residential property, let's say it's cost 1 million. So there are different parts to this property. Let's say number one of that is land, and the other part of that is the building. The value of the building is always decreasing, whereas the value of the land always increases. So overall, your property might be appreciating. We say in the Bay Area, the 1 million house became 1.2 million, 1.5 million. So the value of the property is increasing, but value of the building itself is always depreciating, and we can write off this depreciation against our passive income. So let's talk about accelerated depreciation. So accelerated depreciation is, let's assume you have a property, and for example, let's say your residential property, you are dividing into many different parts. So your property is itemized. Each part of the property is itemized. For example, roof is one part. Let's say maybe the kitchen is one part, or maybe the bathrooms are one part. So let's say these are part 1, part 2, maybe part 3, part 4, part 5, part 6. So there are multiple parts. The building is divided into multiple parts, and each part has a different rate of depreciation. For example, let's say the roof has 10 years depreciation, and the value of the roof is 100k. So if the entire property costs 1 million, let's say we are itemizing it in different parts. So the roof, which depreciates over 10 years, is let's say 100k, and then we have maybe the kitchen, which is 150k, maybe it depreciates like, let's say, over 3 years. Or we have another part, like let's say this is worth 50k and this depreciates over 1 year. Or then we have this part which is like worth 200k and this depreciates over, let's say, 20 years. So yearly depreciation will be here 20k. And for example, 50k yearly depreciation will be again only 50k. For example, we have 3 years depreciation. The value of this part is 150, so it will be 50k depreciation for this part in a year. For 10 years this will be like 10k, right? And we have another part which is like maybe 200k, and then we have the sixth part which is like 300k, and this depreciates over 10 years, so this will be like 30k. And this depreciates over the 5 years, and let's say 200 divided by 5, which is like 40k. And let's assume, like, we are adding all this depreciation, it is about 200k depreciation on a property which is of value 1 million. And can you guess what this 200k is written against? Is it written against your passive income or your non-passive income? And the correct answer is it is written against your non-passive income. That means it can be written against your 1099 or W-2. This is huge, guys. So for example, let's say there is a family who have an income of like combined income of 500k, and they have this property which has an accelerated depreciation of 200k, and this can be written off against your W-2. So now you will be taxed only at 300k. So let's imagine it was at 40% taxes, so just 40% on 200k will be 80k. So you have like saved 80k on taxes on that property, on top of the income which you are getting from the rentals if you're renting it out. I mean, of course you're renting it out. So this and that's a huge money, not only saving on the taxes and also which returns on the property which you get as a rental. Okay, so let's assume like how can normal people like you and me, I don't have a rep status, how can I use accelerated depreciation? So to have a accelerated depreciation, IRS has a loophole which is called short-term rentals. This is exactly your Airbnbs and all those short-term rentals. So if you are, let's say, if you own just one property, for example, if you own just one property, you cannot justify working 750 hours there. So in this loophole, when you have a short-term rentals, if you are working there 100 hours, you can qualify for a rep status. Having a short-term rental and spending 100 hours on that property, you can qualify for a rep status, even if you have one property. If you have two properties, then 100 hours is even more easy to justify, right? So this is called STR, short-term rentals. I hope this was helpful, guys. Also, I just wanted to ask, many of my clients ask me, hey Hima, do you help us implement all this? No, we do not help you to do all this. Let me guide you, to get to know your what is how can you accelerate depreciation. You need to do something called a cost segregation study, which in Bay Area it costs around like 10k. It depends on your different areas have different rates. I'm not sure about the other rates in the other areas. So they do this cost segregation study on your properties, and they itemize or different parts of the property and give you all these values using which you can do the accelerated depreciation. So work with a CPA who knows how to do all accelerated depreciation. Most of the CPAs are aware of that. If you ask them to do it, they will do it. And again, you need to get hire somebody to do the cost segregation study. So we advise our clients as a financial professional, how can they reduce this taxes. So we suggest them this, but this is not something which we implemented because we do not even have a license to implement it, and this is out of what our area of expertise or area of what we do. So yeah, this is, but we advise our client to get it done if this suits if they are interested in doing this. So thank you so much for watching this, guys. If you need help with your financial planning, feel free to book a call with me, or my team will be very happy to help you. Thank you so much for watching. Bye.